I'm Grant Walker. Welcome to Last Call for Wednesday, the 27th of May. I'll be back with Heads Up Thursday at 10 a.m. To crowdfunding, more young companies have launched equity crowdfunding campaigns, including a taxi booking smartphone app and a maker of guitar effects pedals, favoured by the likes of Sting, The Police and Neil Finn. Red Witch, founded in 2003, manufactures analogue guitar and bass effects pedals and has a pedigree client base including John Mayer, Guns N' Roses, the Arctic Monkeys and Trinity Roots. The Wellington-based company aims to raise between $368,000 and $700,000 for a 7 to 28% share. It launched on crowdfunding platform Snowball Effect yesterday and has already reached 80% of its minimum from 52 investments, with 27 days left to go. Red Witch has a pre-investment valuation of $1.75 million based on sales history, forecasts and previous capital raises. New funding will drive global sales and marketing initiatives, which includes running a professional development program for distributors and dealers in Red Witch's key markets, including US, Germany and Canada. Red Witch director Jeff Matthews says, "We've spent a number of years developing a full suite of products, so a lot of the hard work's been done. We've proven," he says, "we've got something that's highly valued by the market, and the awesome reviews and A-list artists using our pedals are testament to that." The company made revenue of just over $368,000 and negative earnings before interest, tax, depreciation and amortization of $173,855 in the year to March 31st, 2015. If it raises the minimum crowdfunding amount, it expects to make $862,000 revenue and $2,699 EBITDA in 2016, rising steadily to $3 million revenue and almost $1 million EBITDA in 2020. Interestingly, the company saw a big drop-off in revenue after 2012, when it had EBITDA of almost $64,000 on revenue of $618,500. Mr. Matthews explains this occurred after Red Witch's then US distributor was hit by the global financial crisis and changed its business and sales model. According to Red Witch, the global market for guitar effects pedals is worth about $195 million US annually and is the fastest growing segment in the industry, driven by a resurgence in the popularity of effects pedals. Snowball is also running a campaign for healthy fast food company Mad Group and is about to launch an offer from Lance Wiggs's Punakaiki Fund. Over at rival equity crowdfunding platform Pledge Me, taxi-hailing smartphone app Tap a Taxi also launched a campaign yesterday. Tap, which was co-founded by former taxi drivers Andreas Bedoya and Simon Hazlitt, wants to raise a minimum of $250,000 and a maximum of $1 million, or between 7.7 and 25% of the company, based on its current valuation of $4 million. The startup made no revenue and a net loss of almost $16,000 in 2015, but still anticipates a massive jump to profitability in 2016. The company, which is also expanding in Colombia, maintains its forecasts are conservative and based on capturing a 10% market share of the 23 million taxi rides in New Zealand each year. Tap faces some competition, including from Uber, which arrived in New Zealand in January last year, and local taxi app operators Zoomy and CabChoose. Pledge Me is currently running an offer for Powerhouse Wind and has indicated it will soon launch a campaign for startup hair and beauty products business Sorbet. Some companies that have run equity crowdfunding campaigns have been criticised for high self-assigned valuations and forecasts, and the Financial Markets Authority warns potential investors to do their homework before parting with any cash. Now a crowdfunding update. A taxi app company which launched an equity crowdfunding campaign yesterday is being criticised for failing to get its offer document correct. Tap a Taxi wants to raise a minimum $250,000 and a maximum of $1 million, or between 7.7 and 25% of the company, on equity crowdfunding platform Pledge Me. But its offer documents were not quite correct, causing confusion amongst those that noticed the error. Yesterday, Tap a Taxi's 2018 forecasts were for $3.02 million revenue and $5.94 million profit in the 2018 year, when it should have been read $8.86 million revenue for the same amount of profit. After NBR pointed out the discrepancy, Pledge Me updated the figures, saying there was an error copying the information over onto the details summary tab on the site. Easily fixed, but the error may plant a seed of doubt in potential investors' minds. One member subscriber told NBR, "If the company can't get its financial documents right, there's no way I'd trust them with my money. Comments on yesterday's coverage echo this view. TAP connects licensed taxi drivers with passengers through a smartphone app which distributes jobs based on the driver's location. Its forecasts are based on capturing a 10% market share of the 8,000 taxis and 23 million taxi rides in New Zealand a year. It's also expanding in Colombia and has incorporated a company there which is 90% owned by TAP. The company, which made no revenue and a net loss of almost $16,000 in 2015, will reinvest much of the early profits, but says it aims to pay a dividend within 2 years. There seems to be a market for it, but it does face competition from the likes of Uber and Zoomy. It has ambitious financial forecasts, and after taking a valuer's advice, gave itself a valuation of $4 million, which it says was based on 4 times the conservative scenario of probable profit and benchmarks against similar companies in similar industries. One source within the early-stage investment sector told NBR Radio the valuations are very high and projections look crazy and have not discounted back 1 year of risk. New Zealand Venture Investment Fund average pre-money is about $500,000 for software seed funding and $2.5 million for startups, making $4 million much higher than other deals of its kind, he says. What would be fair in this case is to accept the valuation of $4 million, but if the company does not get to $1 million in earnings before interest and tax in the first year, then the new investors get more shares. This allows the founders to really back their projections.
NBR Radio, Wednesday the 27th. I'm John Stewart. The founder of a finance company is taking it to court less than a month after he was bankrupted following a $150,000 claim it successfully made against him. Hamish McNichol's been following that case, and he joins me now. So who is this guy, and what's it all about?
Well, basically, Glenn Andrew Walker, who was the former managing director of Geneva Finance, which is now known as GFNZ Group, was adjudicated bankrupt in the High Court at Auckland earlier this month. Geneva Finance, as some people will be aware, it was a rare survivor of the finance industry's collapse, but it went into a moratorium in 2007. Mr. Walker was the founder and managing director of this company, which owed investors about $130 million, and this was actually eventually paid back last year, I believe. Today, Mr. Walker represented himself against GFNZ Group in a closed case management conference at the High Court at Auckland before Justice Patricia Courtney.
What's his claim?
Not entirely sure, but looking through some previous judgments gives a few hints. We tried to contact GFNZ Group's lawyer, Mark Kirkland, as well, but couldn't reach him, and Mr. Walker is representing himself and haven't been able to contact him. But basically, in February last year, GFNZ Group sought a summary judgment against Mr. Walker. This was for a past debt of about $150,000. In May of that same year, Justice Mark Wolford ruled in favour of the GFNZ Group, so Mr. Walker had to pay, and then obviously a year later he's gone bankrupt. So during that original claim, he had acknowledged that there was the debt, but had submitted some cross-claims, saying he would be bankrupt if he was forced to pay, and those cross-claims were submitted just a few days before GFNZ Group's summary judgment application last year.
Now, this is not the first litigation he's been involved in, as I understand it.
No, Mr. Walker has been involved in a web of proceedings from the District Court to the Employment Relations Authority as well as the higher courts. And in fact, in December 2013, the Court of Appeal dismissed another bid by Mr. Walker to basically appeal a District Court decision where he was ordered to repay another debt, which was about $111,000 to G2 Finance Holding, which is a related company.
Right. Thanks very much for that update, Hamish.
NBR Radio. With Clooney Restaurant, an unparalleled private dining room choice. NBR Radio.
NBR Radio. Wednesday the 27th. I'm John Stewart. And I'm joined in the studio by Nathan Smith with his weekly Foreign Affairs scope. Now, Nathan, you're beginning today with Osama bin Laden, his bookshelf.
Yeah, this is the fourth of a tranche of files that have been released. The US military forces that killed him in his Abbottabad compound in 2011 in Pakistan managed to grab a bunch of seemingly useful at the time, probably not critical intelligence from his apartment. And they have obviously gone through it and taken what they needed out from it and released the fourth tranche of this. In the past, it has been one or two documents or a few, but this is quite a lot. And just sort of it's being called his digital bookshelf because people can see what he was reading, what they found there, and what he was thinking about.
And this shows up a weakening Al-Qaeda at the time?
I think so. I think the reasons behind releasing it is in a response to a journalist, an American journalist named Seymour Hersh, who released an investigative story a couple of weeks ago that suggested that the story from the US government wasn't entirely accurate about how they killed bin Laden or found him. And this is a response for some of those claims, saying that the raid didn't happen like it was pronounced, and the things that were found there weren't pronounced. But it does also show that bin Laden at the time of his death and Al-Qaeda Prime, which is his group in the northwest frontiers of Pakistan and Afghanistan, was not the Machiavellian Mr. Burns type in the corner, controlling the Al-Qaeda franchises all around the world. There was a lot of constraints, clearly, on Al-Qaeda. For instance, using couriers rather than emails takes time, and a lot of the moments when they needed to be timely couldn't happen because it would take months to get there. So he was more of a figurehead at the time of his death, it appears from this. He was interested in conspiracy theories. He apparently had a copy of the 9/11 Commission report. But it does show that the Al-Qaeda Prime was weak.
And also it sounds like from this literature, if you can call it that, that it was starting to split up into factions, which we're seeing now.
That's right. So it was already at the time moving to Al-Qaeda 2.0, which is what I've been calling the franchising of Al-Qaeda, essentially not controlled by a central platform anymore, mainly due to US and NATO airstrikes and campaigns against it, broke it up into regional franchise groups like Al-Qaeda in the Arabian Peninsula or Al-Shabaab in Somalia and others.
Now, moving on to the TPP fast track, it's now passed through the American Senate and goes on to the House of Representatives.
That's right.
So what are we looking at here?
Well, the House of Representatives probably is assumed in the media and assumed by insiders to be more of an obstacle than it was for the Senate. I believe some corporations, including Boeing, helped push the ideas through the Senate. So there's obviously some private interests with the TPP as well as the US government interest. But it just reinforces again that the TPP is essentially an American story. They're the largest player in this particular deal, and what they say goes. So coming back, Congress will come back on the 1st of June after a 10-day holiday over Memorial Weekend, and it will decide what it wants to do with this. But the potential for the House to reach the required 217 votes on this out of a possible 400-odd is unlikely. There seems to be about 17 that are fully on side of this at the moment, but that leaves about 200 to be convinced.
Yeah.
So the numbers could be tight. Some are predicting it will go to a second vote, just as it did in the Senate. But it would be hard to bet your house on this at the moment, but there are some optimism.
Now, a meeting in Guam has been cancelled. What's the story there?
Yeah, that's right. There was a ministerial meeting that was booked for Guam last week, but it essentially was cancelled because the TPA, the fast track, has not been passed in the States. Again, reinforcing that whatever the others are trying to do in their own nations, they are waiting on the US to push this through. So we're unsure when the next ministerial level meeting will occur, but it does ride on the decision in the House.
So to the Islamic State and Syria. Now, IS has taken Palmyra in the Homs district, and of course that's an enormously historic city, and there are fears that they may repeat what they've done elsewhere and smash historic treasures. Although I have heard an argument that Palmyra is post-Muhammad, if you like. It's an Islamic monument. So they may, on those grounds, leave it alone.
Potentially. Immediately once they walked into Palmyra, They rounded up a number of people that they didn't like, and there are reports that about 400 were beheaded. Again, status quo for the Islamic State, but taking Palmyra this deep into the western territories of Syria really doesn't help the regime efforts. I don't know if anybody's really gaming for the regime anymore, but essentially the thoroughfare from Damascus through to Deir al-Zor in the east relied on Palmyra to be under the control of the regime forces. Having lost that, those forces in Deir al-Zor in the east are now almost completely encircled. They can probably still be resupplied by air, but it will take a lot of effort because the regime forces are now, especially by ISIS and other rebel forces, are now embattled on multiple fronts. In the north, in the west, ISIS now, after taking Palmyra, is pushing west even further into the core territories of the regime. And it's essentially pushing and spreading the regime forces over a long front, which is exactly what ISIS did in Iraq. Cut and divide, and that's how you defeat these forces. But it could also bring IS now into contact with Jabhat al-Nusra, the al-Qaeda group working in Syria, which means an enemy of my enemy is my friend, essentially, from Assad's point of view, which is his strategy for a long time now. But Assad is now pushing and retreating at the same time in multiple fronts, and it's hurting.
Now, south to Iraq, of course, they've taken Ramadi.
Yeah, that's right.
And does this take them closer to the Jordanian border?
There was also a strike, pretty deep strike by IS on the Iraq-Syria border, down in the west of Iraq, closer to Jordan, which will be frightening the Hashemite regime there. No sweat there. But it does show that IS still have the options of light infantry and especially light cavalry movements, almost at will. But there is a little bit of a misunderstanding as to how important the retaking of Ramadi is, and especially in regards to how the Iraqi security forces retreated so quickly. I think what can be taken from that is not necessarily how would you say, a refusal to fight from the Iraqi security forces, but it's a lesson that they learnt in Tikrit, that if you let the Islamic State take a city, they get concentrated in an area rather than being spread and, as I said before, using their highly advanced light cavalry tactics. They will essentially be sitting ducks for airstrikes or any sort of reprisals from the Iraqi security forces. So tactical retreats, overall strategy may be a little bit hairy with the Iraqi security forces, but they're not doing anything unwise at the moment, and so it would be silly to assume that they are losing, so to speak.
And where's Turkey in all this?
Turkey and the US came to a provisional, in principle, conclusion this week of protecting rebel training groups in the north of Syria, closer to the Turkey border, by air power. So it's bringing Turkey into this fight now, little bit by little bit, and the US is doing all it can to maintain security in the region, but it's still very tentative, and Turkey is not wishing to get as heavily involved as, say, Saudi Arabia, Jordan or Qatar.
Right. Well, we'd better wrap it up there this week, and thanks very much for your Foreign Affairs Scope, Nathan.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
Let's talk charities. A charity lawyer says black letter interpretations by regulators have led to hundreds of charities being unfairly stripped of their registered charitable status. Sue Barker Charities Law Director Sue Barker says the definition of what is or is not deemed charitable, which draws on hundreds of years of case law, is complex and is up to the interpretation of the charity's regulator. She says many of those interpretations are arguably too narrow, which is frustrating charitable works and having an enormous chilling effect on the sector. Ms. Barker says the unwarranted stripping of organisations' charitable status by the charity's regulator is having an enormously destructive impact on the sector. She says charities are being culled. These narrow interpretational decisions which lead to good charities being deregistered can be and often are a fatal blow. Many smaller charities struggle to attract funding if they are stripped from the register. It gives the implication a charity has done something wrong, which in many situations is not the case. Last week, NBR Radio reported many smaller charities have been forced to liquidate as they were not able to afford court costs to appeal the decision to strip them of their charity status. New Zealand Initiative Research Fellow Jason Krupp says many of these decisions by the charities regulator were unfair. Although Ms. Barker says it's difficult to get a clear picture of how many charities have been deregistered since the Charity Services website was changed, she says she can make an educated assumption. She says, I would say, based on information that I have seen published, there are hundreds of good charities which are being either deregistered, denied registration, or who see the writing on the wall and don't go any further because of these black letter interpretations. And this does not include charities that have been deregistered for failing to file an annual return, which she says she has no problem with. Ms. Barker says, from what I'm seeing in my practice, the New Zealand charity sector is being deconstructed at the moment, and if the current situation continues, I expect we will see many more good charities fall. She's calling for a post-implementation review of the Charities Act, which she says is essential and urgent. In business news, Energy Mad, the unprofitable light bulb maker, which counts NZX's Superlife as its biggest shareholder, narrowed its annual loss in the 2015 financial year after stripping out costs. However, the accounts were still tagged by the company's auditor over its ability to generate cash. The Christchurch-based company reported a net loss of $3.2 million or 7 cents a share compared to a loss of $5.7 million or 13 cents a share a year earlier. The year earlier loss included a $1.4 million write-down on research and development costs. Revenue fell 21% to $5.9 million in the latest year on weaker Australian and New Zealand sales. Administration and general expenses dropped 17% to $2.9 million. Energy Mad was in negative equity of $56,250 as at March 31st after generating losses totaling $19.7 million, and its operational cash outflow widened to $2.8 million in the year from an outflow of $1.5 million a year earlier. It raised $2.2 million through share issues and $1.8 million from a convertible note sale during the year and held $1.3 million of cash as at March 31st. The accounts were tagged by auditor PwC, which said there is a fundamental uncertainty over its ability to remain a going concern. The auditor says the ability of the group to continue an operational existence is dependent upon its ability to generate positive cash flows from operations. These conditions indicate the existence of a material uncertainty that may cast significant doubt about the group's ability to continue as a going concern. Energy Mad's audit fees for the financial statements rose to $57,750 from just over $55,000 a year earlier. The company's directors retain their optimism the company will survive based on existing cash on hand, the 2016 forecast for increased sales, primarily in Australia, a significantly lower cost base and support from shareholders. They noted uncertainties arose from Australian sales falling short of expectations from securing appropriate supply from the firm's Chinese manufacturing and generating enough activity in New Zealand. Chairman Rick Ramsey, who signed off on the accounts, says he won't be standing for re-election as a director at the company's July 22nd annual meeting in Christchurch. Superlife's stake in the company has risen to about 45.6%, reflecting the fund manager's role in underwriting capital raisings. The company focused on stripping out costs in the latest year after struggling to gain traction since listing in 2011, consistently missing prospectus forecasts. Energy Mad is anticipating administration and general expenses will fall to $2 million in the 2016 financial year, bringing it closer to break even. The shares last traded at 6.5 cents and have dropped 33% this year. The stock was sold at $1 a share in its 2011 IPO. Let's talk world investment in Auckland. Auckland is sitting at 7th in the world for real estate market liquidity and direct investment volumes. Real estate company JLL's latest City Investment Intensity Index shows investment in Auckland property over the past year doubled. The city is one of the region's most transparent markets, and it's punching above its weight in attracting real estate investors. The index compares the volume of direct real estate investment over a 3-year period relative to the economic size of the city. JLL New Zealand Managing Director Nick Hargraves said the index is also a useful barometer of the city's overall health. He says this is Auckland's best ever performance and a key indicator the city is beginning to reach the global forefront in terms of its transparent and liquid real estate markets. Auckland's competitive advantage is its high-quality commercial stock that is encouraging international real estate interest. JLL New Zealand's research head Justin Keane says the survey is a useful measure. He says it's much like a free float measure for a stock market and that it indicates both the availability of quality stock in the market as well as the propensity of investors to transact in that market based on the investment market outlook. For Auckland to beat New York, Singapore and several major Chinese markets underlines the attractiveness of the location. London maintains the top spot. The global top 5 is completed by Munich, Oslo, Stockholm and Copenhagen. Tech-rich cities with a high quality of life and strong environmental credentials, factors which are increasingly being incorporated into investment strategies. Sydney is in 6th position, remaining a strong favourite with domestic and international investors. The draw of financial centres continues to be strong, with 3 of the world's most important financial hubs, New York, London and Singapore, as well as Frankfurt and 9th spot, all featuring at the top of the index. The super cities are represented by London, New York, 23rd, Paris 14 and Tokyo 21st, the world's largest real estate market, with investment volumes over the past year almost 30% higher than the previous 12 months.
NBR Radio with Hotel de Brett, your home away from home, but with better service. NBR Radio.
In market results, Green Cross Health, formerly known as Pharmacy Brands, posted a 4.1% decline in annual profit as its staff costs increased. The Auckland-based company said in a statement profit attributable to shareholders fell to $14.4 million in the year ended March 31st from $15 million a year earlier. Group profit, including the share of non-controlling interests, increased to $18.9 million from $18.8 million, with non-controlling interest receiving $4.5 million in the latest financial year, up from $3.8 million a year earlier. Sales rose 25% to $322.4 million, while cost of sales rose 15% to $168 million. The owner of the Life Pharmacy and Unichem pharmacy chains has been widening its portfolio of businesses, agreeing this month to acquire Access Home Health, a not-for-profit home healthcare services company. That adds to its purchase of medical centre business Peak Primary and a 50% stake in community nursing and healthcare business Total Care Health. The company's assets increased to $191.1 million at balance date from $134.5 million a year earlier, while its total liabilities increased to $91.6 million from $45 million. Chairman Peter Merton said, "We believe we've achieved a significant amount during the year that sets the company up well for the future. The acquisitions of Peak Primary Medical Centres and Access Home Health establish us as a leading player in New Zealand's primary healthcare market, a development we've successfully managed while achieving strong sales and franchisee growth in our pharmacy business." Sales at its pharmacies increased to $265 million from $246 million a year earlier. Its medical services unit doubled sales to $24.7 million. Its new community care unit reported sales of $32.5 million. The board declared a final dividend of 3.5 cents a share, unchanged from a year earlier and payable on June 19 with a record date of June 10. Shares of Green Cross have advanced 17% since the start of the year. And now a possible solution to the Auckland housing crisis. Should New Zealand build bigger cities or help provincial and rural areas grow by bringing them closer to the cities? Tauranga City Council believes it has the answer: better transport and particularly rail. The council says more affordable housing land could be opened up in areas outside Auckland if there were improved transport, making travel times faster and bringing existing communities closer. It says rural communities and areas with sound economies often have capacity for more people, established social networks and facilities and affordable housing stock. Council planners say if New Zealand were able to deliver high-speed rail equivalent to England's 400 km/h trains, travel times between Tauranga and Auckland would be 30 minutes instead of 2.5 hours by road. This would make Tauranga a legitimate location where people could live while working in Auckland. The council says this type of infrastructure would open up areas like Hamilton and North Waikato towns such as Huntly and Pokeno for significant residential development with short commutes to Auckland. This would mean Auckland might not need to expand so much, easing some of its infrastructure challenges. Council planners say provincial and rural areas have the advantage of much lower house prices than Auckland and a plentiful amount of land that can be developed. They concede rail itself might not be a financially viable proposition, but there could be other alternatives to achieve similar results: rail lines that run at more moderate speeds and improvements to the strategic road network.
NBR Radio, Wednesday the 27th. I'm John Stewart. Tourism consulting group, the Fresh Information Company's managing director Shane Vuletich has told NBR there's a mismeasurement when it comes to the amount of money Chinese tourists are spending in New Zealand. I'm joined by Jason Walls, who's been covering this story. Jason, can you explain what Mr. Vuletich means by this?
Yeah, I can. It's been a very interesting story to work on because obviously there's this perception out there that there is a lot of Chinese people spending money in the New Zealand market. Now, first of all, I'd like to clarify that it's not a perception that there's a lot of Chinese coming to New Zealand. That's a hard fact. We have the arrival numbers and we can see that. However, what Mr. Vuletich was saying was that it's not the billion-dollar market that the government's been saying it is. In fact, he says it falls well below forecasts, and there's actually other countries that might be spending more in in New Zealand, rather than the Chinese. Yeah. So I'll just outline to you quickly about how they get this information. So they get the email addresses from the international visitors at the 4 major airports in New Zealand. So it's an email thing. So they get the email addresses and then they send them a survey in which they fill it out and say how much they've spent, where they've spent it. And then the appropriate entity takes that information and breaks it down. So, I mean, already on the surface, it's sort of like an iffy system. I mean, you sort of think about it like, how would they even know where they spent their money, first of all? And I'm sure there's a lot more that goes into it, but just on the surface level, it seems sort of a bit off. And even Tourism New Zealand Chief Executive Kevin Bowler was saying that there's actually no better way to get the information at the moment. There is some stuff to do with international credit cards that they use to back up the data, but in terms of just getting it, this is the best way forward currently. I mean, I'm not sure if they're exploring new possibilities. So Shane was telling me that Chinese visitors account for 9% of visitor arrivals and 7% of spend on hotel rooms. So he says that there's actually quite an imbalance to the amount of money that the government says that they're spending, which is close to 14% of all nationality countries that come to visit New Zealand. Basically, and what he said, and I'm just going to read you a quote that he said because I think it encapsulates what he was saying perfectly. He says, "This suggests either Chinese visitors spend much more than the average visitor or that the value of the Chinese market is grossly overstated."
And he's saying that it's overstated.
He's saying it's grossly overstated. Yeah, he's not very confident in those numbers at all.
So what have the business ministry said about this?
Well, so I talked to the sector's performance manager, Peter Ellis, and he said it was basically the former. He said that Chinese visitors are spending more money than other visitors. He also told me that many people in the tourism industry don't actually believe this billion-dollar figure. And so when I was talking to him, I was sort of surprised that he was sort of like, yeah, I've heard this before, which was... I mean, we had a good chat about it and a good long chat, and I got a lot of good information. But what he was telling me is that when Chinese come to New Zealand, they don't tend to spend so much money on tourism-related activity.
Right.
And that's why there's this perception out there that they don't spend as much.
They're not big on bungee jumping, in other words.
Yeah, maybe that's the case. I mean, I've never done bungee jumping either. I see the people jumping off the Sky Tower, and I'm like, maybe not for me. Or maybe I did. I don't know. I've never tried it. But basically, he was saying that they're big spenders in other areas, such as duty-free shopping and what else? Just like retail stuff.
Yeah.
So, and just to sum up with a quote that he said, they're only here for a short while, but they spend up big while they're here.
Let's hope that continues. Thanks very much for that, Jason.
NBR
Radio.
Free to air online. NBR, the meeting place of intelligent business.
To roading, the government will put the financing and construction of the Puhoi Warkworth Highway out to tender as a public-private partnership, or PPP, a structure that Transport Minister Simon Bridges says may free up $1 billion of state funding for other projects. The Auckland to Northern Link Road will be the second of the so-called roads of national significance to be developed using a PPP after the Wellington Gateway Partnership, led by a unit of ASX-listed Leighton Holdings, won the contract to build the $850 million Transmission Gully motorway north of Wellington, set to open in 2020. Mr Bridges said the Cabinet has approved the NZ Transport Agency to move to the next stage of procurement as a PPP to finance, design and build the project. NZTA will invite private sector companies to put forward proposals for financing, designing and constructing the highway, with a view to awarding a PPP contract in October 2016. Mr Bridges said if, however, the private sector can't offer value for money, NZTA will instead revert to a more traditional procurement model. Construction without a PPP would likely begin around 2 years later than under a PPP. Let's talk property. MAT Property Group's latest property syndication offering, shares in the IRD's leased building at Manukau, has closed oversubscribed. The property group offered 210 parcels of $50,000 $1 shares in the property at 5 Osterley Way. Osterley Way Investments bought the office building for $18.8 million and offered investors an initial projected income return of 9.25% a year. The syndication has been set up under the PIE scheme and is the third syndication MAT has done using the tax advantages it offers. Completely refurbished in 2011-12, the property is leased to the IRD for 9 years, and syndication broker Brian Caldwell from Bailey's North Shore Commercial says the syndication generated strong demand. This is the 9th property Albany-based MAT Property Group has syndicated, with the others ranging in value from $4 to $25.5 million. In market news, building industry constraints have splintered Metro Performance Glass sales forecasts, and the market will be attempting to assess the company's future prospects. New Zealand's largest glass processor, which listed on the NZX last July, reported $9.6 million profit in the 8 months to March 31st, ahead of $9.4 million projected in its prospectus. While sales grew 11% on the previous corresponding period, they came in at $115 million, 2.4% below the forecast. Management said this was not due to Metro Glass losing market share, but industry-wide capacity constraints. The increased number of building consents in Auckland and Christchurch compared to the lack of labour are outweighing capacity to actually get the build started. Metro Glass shares have fallen 4.4% today to 176, still above the 170 IPO price. Macquarie Senior Investment Advisor Brad Gordon says the market will be trying to determine what growth potential the company has, given the constraints on the industry. He says the market will be a bit concerned that there was a miss on the top line and will be trying to gauge whether this is a one-off or not. The lack of labour is due to a low unemployment environment, so it's about getting trained, skilled staff, which is a macro government issue as much as anything. Mr. Gordon points out other building companies are suffering the same issues. Fletcher Buildings and James Hardy's local operations also indicated consent work lag in results presentations. Mr. Gordon says despite the headwind to growth, by and large, the company is controlling its controllables. Metro Glass retrofit business is beginning to ramp up as the company drives advertising campaigns to get older houses double glazed. Mr. Gordon says this could carry them through capacity constraints as they're not reliant on other parties to get there. But Metro Glass chairman Sir John Galter warns not to get hopes up too much over the year ahead. He says, reflecting the industry constraints on capacity, we believe the current building cycle will last longer but have a lower peak. The frequent delays to projects in both the residential and commercial markets could make achievement of the PFI revenue target for the 6 months to September 30, 2015 more challenging.
NBR. Need to hire? Try our online recruitment platform www.nbrtalent.co.nz.
NBR Radio, Wednesday the 27th. I'm John Stewart. We're taking a look today at the changing advertising landscape as the influence of Gen Y, or millennials, becomes ever more significant. I'm joined by Dean Taylor, who's CEO of Contagion, ex-Saatchi & Saatchi as well, and he was boss there. 20 years experience in the industry and specialising in a company's overall brand. Also with me is Tom Bates, who's Social Influence Director at Contagion. He's a social media professional who was Marketing Director for Rhythm and Vines and Air New Zealand's social media specialist. Dean, just starting with you, we're seeing a major generational shift in viewing habits. How will the rise of the millennial affect media companies in the future, do you think?
Well, we did a study recently, and we looked at generations in the last 30 years and how things have changed. And every youth generation wants to have a voice. They're all rebellious. But we thought there's one factor that's really changed here. And the biggest factor is that they can broadcast back. They've got an opinion, and that can actually change everything. So a couple of things are going on here is that brands and the media generally have to cater to them more, because if they don't please them, they've got all hell to pay online.
Exactly. So it's a far less passive environment than it has been up until to date.
There's an immediacy to it, John, that as soon as you put something out there, people are going to, as I say, shout back, and they've got to be more on your feet. So no longer will we be simply broadcasted out. And this is where YouTube's end line comes from. Broadcast yourself, and my word, are they broadcasting themselves?
Yeah, is this an issue for you as well, Tom, in terms of that loss of passivity?
Well, I think for me, as someone who just falls into the millennial, I'm sort of embracing this world because the institutions or companies are having to recognise the values and potentially the behaviours of our generation. And I think what's happened is we've moved from the age of information in the 90s when Google sort of freed up or democratised a lot of the information that was out there to the age of the consumer when you basically have everything at your fingertips through your mobile, whether you're ordering your taxi now with the click of a button or Uber, you're watching TV or music from anywhere over the world. What you're seeing is that the power has shifted from companies to the consumer, which is quite exciting in my point of view.
But Tom, are the companies in New Zealand doing enough to adapt to this trend you've just described?
I don't think many companies are, because there's not as much of a burning platform in this market as potentially there are in bigger markets. We're seeing in the US and Europe many companies have adopted digital and mobile and social media marketing a lot faster. The brands in New Zealand that have done well have generally been brands that have an interest in New Zealand but are challenger brands overseas, such as Tourism New Zealand and Air New Zealand, who have to act differently, who have to be bold and do things differently, because you take them into America, Australia or Europe and they are a challenger brand, so can't afford to
What do you mean a
doing the same
challenger?
thing.
What do you mean a challenger brand?
By a challenger brand, meaning brands that aren't necessarily the incumbent or the dominant force in that market. So if you're Air New Zealand, you're not a challenger brand in New Zealand, but if you're going into the US and competing against the Virgins, the Deltas of this world, you are not a big brand. You've got to be smarter and wiser with your budgets, and through digital and social media you can do that.
And Air New Zealand have been very clever with this.
Have they?
Obviously, very clever. Their whole strategy of the safety videos. Some of those videos have got millions and millions of views. So instead of going to trying to pay vast amounts of money to American broadcasters, they've gone, no, let's not play the game we find. Let's shape the game in a different way. And they've come up with really entertaining, controversial pieces of media that people have self-selected and decided to watch themselves. So their marketing plan, as it were, resembles nothing that was ever seen 5 years ago.
Yeah.
It's really clever.
Right. A sort of cross between entertainment and advertising,
That's absolutely
I guess.
right.
Plus a safety message in the
message.
case of those
And that's what millennials
videos.
do, because they can self-select what they want to watch. So by God, it better be entertaining, or nobody's going to tune in.
Yeah, exactly. Now, Dean, global mode is a hot topic in the media landscape at the moment, especially in the context of eyeballs migrating from TVs to computers. How will advertisers respond if the broadcasters lose this battle?
I think the broadcasters will lose this battle. I think they're very much like the record companies trying to say no to people file sharing and whatnot. Ultimately, the people decide, so they'll absolutely choose. I think TV's always going to have a place in society. It's what bonds people together. But advertisers will equally always find ways to advertise to people. As Tom mentioned, with millennials, they're on their phone and they're on the internet more anyway. So they've been gradually migrating away from TV. So I think for advertisers, we will always go where the eyeballs are. So if you're watching global mode on your phone, we can still hit you with so we can use geolocation. We know you're watching it from here, so we can still hit you with advertising. So we'll do that. We might not spend as much money with the broadcasters, because if the eyeballs aren't there, but we will find them because technology allows us to select age and exactly where you are.
Tom, do you think the big four who are bringing this litigation will actually lose, like Dean seems to think?
Well, it is interesting. I think in the short term, they may win the court case because that's, sort of the law potentially hasn't caught up with where the consumer feels there's value. In the long term, though, as Dean said, the consumer wants what's rightly available in other markets, which is content in the right platform at the right time, and that's sort of driving change. I think what we'll see over the next few years is that the likes of Sky or potentially the more traditional institutionalised media owners having to adopt greater technologies a lot faster than they're doing. They're only doing it now after a couple of years once they realise they have to. You're seeing the Netflixes in the US really disrupting that market, and you're seeing that happen across music, entertainment and a lot of other sectors. At the moment, a lawsuit isn't going to build loyalty with the consumer. It's going to maybe shut down global mode for a year or two before something else comes up. So
essentially you're saying the battle might be won, but the war in the long run
absolutely
will probably be lost.
Yes, exactly.
Yeah. Now, Tom, the Interactive Advertising Bureau recently undertook measures to address concerns about how native advertising is disclosed. I must say, as a journalist, I find this issue quite close to my heart. I mean, should the disclosure of native advertising be a concern? Should we be insisting that it be disclosed in some form or other?
Yeah, I think it should be. I think if you look at advertising today, the principles that are actually starting to resonate with millennials or anyone is authenticity. People are buying from brands. They want to read, news sources that they trust. Therefore, they're happy to open up to native content if it's disclosed and relevant. What is where the grey area is, and because this is a trend that has sort of came really quickly, it's much like advertorial, editorial in the old world.
Yeah.
When there's people being misled, therefore the trust is lost, and therefore the whole business model falls down. If, however, you're aware that it's native content, and it's sponsored by an advertiser or co-created between a journalist and a brand, and that is disclosed, therefore, if that content is relevant to an audience, then people are much more likely to A, engage with it and find it useful, but B, be open to the messages. As soon as you start to mislead, that's when there's a massive problem.
Dean, your thoughts?
I think there's very much a barter model going on here. Give me a good piece of content and I'll reward you with my custom. But don't fool me, because I'll punish you for it. And we talk about, instead of interrupting people in media, we enhance the moment. So they can be looking at something. We'll add an additional piece of content in there for no charge and say, by the way, this is from this sponsor. And you go, great, you've actually got me what I'm interested in and you've added to the topic. So that's a really clever way of doing it in my book. So, yeah, make my life better with your message. Don't interrupt it.
So a greater level of sophistication will be required, really.
Because of digital, we can track what you're interested in, where you've just been on the web, do you like cars, what sort of car do you like, and then we can serve you up the relevant content to you. So in many ways, we're getting the right message to the right people in the right mood, so therefore they feel positive about that brand.
The big commercial thing, I think, to add to the value exchange that's required, is that banner advertising is, becoming very, very difficult to make work. People don't want to be interrupted. They don't want to click on things that are irrelevant or trying to stop them from doing what they want. People are looking for content online. And when people are looking for content online, they're not as worried where that comes from, as long as it's fulfilling their need and they trust the source. So obviously commercial arrangements coming to how that content can then facilitate better journalism or more journalism or a financial business model is really where we're coming to. If we can help, prop that up and it is transparent, then it can be a win-win. The problem is at the moment, with no legislation in place, people are always going to take the mickey.
Yeah. Well, gentlemen, thank you both very much for your insights into this emerging area of communication, I guess would be the way to describe it. Many thanks.
Thank you.
NBR. With a National Business Review smartphone subscription, you can read or listen to the latest from NBR online. And for a limited time, it's free. Join NBR's Intelligent Business Network today and get free smartphone access to NBR online until August 31st. NBR doesn't do sport, weather or horoscopes, just timely, relevant, useful and insightful business news. So for business news you can use for free, visit nbr.co.nz/free.
Let's talk what workers want. A survey published today by human resources specialist Randstad shows New Zealand workers rated work-life balance as the most important factor in keeping them with their current employer, while job seekers continue to view salary and employee benefits as the number one priority. The survey showed among nearly 8,000 work-aged Kiwis polled this year, more than 53% weigh work-life balance the most on their decision to stay with the current employer. But for people looking for work, only 10% rated that as the biggest attraction in a job, up from just 4% in 2012. Randstad New Zealand country manager Brian Keegan said, as far as New Zealanders are concerned, there is more to a job than money. However, money continues to trump conditions. For the fifth consecutive year since the survey was started, salary and employee benefits rank highest of 5 most important criteria for choosing an employer by 21% of respondents. That's followed by long-term job security at 12%, interesting job content on 11%, and pleasing work atmosphere at 10%. The survey found 20% of respondents said they would change jobs in the next 12 months, citing lack of career opportunities, loss of interest in job content and low compensation as the main concerns, which is consistent with the global trend. To Sky TV. Chief Executive John Fellett says video streaming over the internet presents Sky Network television with more opportunities than it does threats. But investors shouldn't expect the company to increase dividends as it invests to meet the challenges it faces, Mr. Fellett told NBR Radio after yesterday's Investor Day. Sky will have to draw down debt to maintain its 2016 dividends at 70% of net profit as it meets capital spending commitments. These include $30 million a year through to 2023 for its Optus satellite commitments, capitalised costs of about $50 million in 2015 of installing and maintaining set-top boxes, and its TV station assets are 9 years old and will require replacing, which may cost about $40 million. As well, Sky will need to refinance its $200 million of bonds maturing in October 2016. Mr. Fellett says the bonds will be rolled over. Sky is currently producing annual positive cash flow of about $300 million. Mr. Fellett says there's a desire by some investors that we ought to pay more dividends. We would love to pay more dividends, but keep in mind what our business looks like. Currently, he says the business can handle all this, provided we keep the dividend at 70%. The company is facing significant changes in its industry, and an agile balance sheet is important. One sign of these changes is that Sky programming costs are going up. Historically, they've been between 30 and 33.5% of revenue, but the company expects them to rise to be 35% in 2016. Sky has increased the volume of content on its Sky platform, launched at its own over-the-top products, including Neon and FanPass, and because of these rising content costs, has increased its charges for its basic and sports tier prices by $1.15 and $1.61 a month respectively. Mr. Fellett says it's too early to judge whether Sky will see any kickback from customers as a result of the price increases, and it won't really know until the summer, once the major winter sports programs have finished. But he says Sky has been losing some sports content, and we want to make sure we don't lose any more valuable content.
NBR Radio, Wednesday the 27th, I'm John Stewart. Well, Amy Adams, Minister for Communications, has told NBR that Chorus and Vodafone might have dominated contracts for the government's $1.6 billion or so in broadband infrastructure spending so far, but some local councils are lining up bids for new funding with smaller players. Here to talk to me about that is our technology editor, Chris Keel. Chris, how much more money is the Minister handing out?
On the campaign trail, we saw Labor promise about $30 million more for broadband infrastructure spending, with the National last term spent around or north of $1.35 billion. And Amy Adams came out and comprehensively out-laboured Labor by promising a $360 million top-up to what's already been spent, so $210 million more for the Urban Ultra-Fast Broadband, or UFB, project, and around $150 million more for the Rural Broadband Initiative.
Okay, so what indications do we have of where that money's going?
The two fibre rollouts that are underway in the city and the country, the lion's share of that has been done by Chorus in the cities and Chorus and Vodafone in the country. But the way the process has started out for contesting the new money, it's been led by local councils, and what we've heard from people involved in the process is that they've been encouraged to partner with smaller players from the dozens of little rural and provincial ISPs out there. Right.
So there are a whole lot of rural and provincial ISPs. I wasn't aware of that. I thought it was just the big players.
Yeah, they've formed a ginger group called the New Zealand Wireless Internet Service Providers Association, or NZWIP.
Right.
And there's a guy called Chris O'Connell, who's sort of their de facto spokesman. He's also got a very good website called hillsholesandpoles.co.nz, which is worth checking out. And he's saying that a lot of NZWIP's members can actually do things cheaper than the big boys like Chorus and Vodafone. So, they turn up on a ute with a ladder on the back, and for, say, a big rural cell site or wireless internet mast, they'll they'll know the local farmer. They'll get them to, if it conks out, they'll get them to go up the hill and check the solar panels on it maybe, or hit a reset button. And, if they have a problem with laying fibre cable ducting in a small town, they'll know someone on the council. They'll slip a meat pack to them and they'll get the consent process through. I'm sure some of it's on a more formal basis, but he's saying, they know their local communities, they know how to deliver good fast broadband a lot cheaper.
And that would be much better as far as the local councils are concerned, I guess. They know what they're dealing with.
Yeah. So there's also the aspect of it that Amy Adams and MB are looking for councils who can come up with the best plans to encourage more use of fast internet infrastructure, and who can help with consenting and stuff. But they also seem to be looking for councils who can deliver the most support around business plans, and that seems to be maybe code for councils who'll kick in the most ratepayer funds as well. So I'm just wondering if there may be a bit of local body tax subsidy sneaking in there as well.
Yeah. Any indication, Chris, that of the level of uptake in our rural areas? Are farming people generally lapping this up?
We know that in the cities, the uptake of the UFB has been quite low. About 13% of the people who can connect now have connected. With the rural RBI, it's been very hard to get figures out of MB on uptake. So the smaller players are presuming that means it's stalled a little bit, and they're muttering darkly that maybe it's just a bit of a crown subsidy for Vodafone and Chorus to extend their share, and they're seeing the lack of information or trying to exploit it for saying it's another reason why they should get a slice of the pie as well and get some of the new money.
From your reading of it and talking around the industry, why do you think the uptake in the towns is so low at 13%? Is there any smart analysis of that?
I think in part it's because Spark has been so late to the party because it didn't have any voice product for fibre, and Spark is about 50% of the market. More broadly, I think it's because ISPs can actually make a good lot of money, in many cases, in fact, more money from the old copper line. So they've got no particular incentive to encourage their customers to upgrade to fibre. In fact, some of them, they'd make less money. And on the government side, we barely hear a peep. I mean, in Australia, for their national broadband network, which is the equivalent project, they've had sort of splashy TV ads and like work from home, businesses do cloud computing, so forth, at least under the previous government. Here, it's just a very low profile. There's a lot of people, a lot of businesses are just unaware of the benefits of fibre over copper.
Yeah. And, of course, there are probably quite a few like me, a bit of a Luddite, admittedly, but nevertheless, we have very fast broadband speeds in the centre of Auckland, and we see no reason why we should get UFB unless we want to sit down and watch movies all day.
Yeah, I think business is moving to the point where everything's going to be online. Cloud computing and copper, it's not reliable for that, especially it's very slow on the uptake with at home for the streaming video craze. We've seen a lot of congestion in the evenings because copper does get easily congested as many users share the same bandwidth. Fibre is a lot less susceptible to that, so if you upgrade to fibre, you're a lot less likely to encounter those internet traffic jams and slowdowns during prime time.
Well, as you say, it does sound like it's a decided benefit for business, but it's a question of making business aware that they should be taking up this fibre that's rolled up to their door. Yeah, so it'll be interesting to see how it unfolds. Thanks very much for that, Chris.
NBR Radio with Bayleys, New Zealand's leading commercial real estate company.
I'm Grant Walker with Last Call. Here's what's trending on NBR Online. So Bob kicked off an Air New Zealand flight. More Saudi farm revelations. The government seeks highway savings. Westland affirms milk payout and lifts forecast. Energy mad, Narrows lost, but big questions remain. An advertising stoush as the question is asked, when is a pitch not a pitch? And more results, including Sky City, Turners, Metroglass and Mainfreight. To find out more on our stories, log on to nbr.co.nz or stay tuned. Those stories coming up next on NBR Radio. To the cruise industry and ports of Auckland. Auckland Council is pushing ahead with finding a suitable berth for mega cruise ship Ovation of the Seas on its first visit to New Zealand next year. Auckland Council's City Centre Integration Group took over negotiations after Ports of Auckland turned away the giant cruise ship because work on a second and longer new wharf has been put on hold for at least a year while a port future study is carried out. Although the port berths the longer Queen Mary II at Jellicoe Wharf, it says it can't afford to close down cargo operations for a week every time a mega cruise liner comes to New Zealand. City Centre Integration Group Communications Manager Oliver Roberts says the group is determined to find an area where it can berth the 348-metre liner, which will carry about 5,000 passengers on its 2 visits next summer. He says, we do not want to miss this opportunity and have to wait another 3 to 5 years for Royal Caribbean's next schedule of visits to be made. It's too important as Auckland and the country will lose millions of dollars for the economy. Mr. Roberts didn't disclose the options the group is looking at. But Royal Caribbean has said it needed an answer quickly before it would announce the itinerary for Ovation of the Seas' maiden voyage. If the cruise liner can't berth at Auckland, it's unlikely to come to New Zealand as the city is the main changeover stop for passengers. Ovation of the Seas will be the longest cruise ship to ever visit New Zealand. In People News, property magnate Sir Bob Jones was ejected from a domestic Air New Zealand flight after refusing to take instructions from cabin crew. The 75-year-old Hunt Valley resident had boarded flight NZ420 from Auckland to Wellington when cabin staff attempted to instruct him in his duties as an emergency exit row passenger, where he was seated in row 12 in a window seat. Jones kept reading when the staff member sought to deliver him and other passengers a routine safety briefing and became argumentative when asked to stop reading, again refusing to be instructed on emergency procedures. Told he could be moved to another seat if he was unable or unwilling to assist in an emergency, he refused to be moved and asked to be left alone, according to passengers in the same row who witnessed the incident. 2 Civil Aviation Authority staff were summoned to the plane to escort the former politician, sometime author and boxing enthusiast, who owns a suite of commercial and industrial properties in New Zealand and Australia, which the Robert Jones Holding website says is valued at more than $1.5 billion. The flight was delayed some 20 minutes, prompting an apology from the flight's captain, who said no matter who you are, passengers had to obey CAA regulations, which included paying attention to safety briefings. An iconoclastic newspaper columnist with a penchant for thumbing his nose at authority and any and all manifestations of the nanny state, Sir Bob is fabled for striking television journalist Rod Vaughan, who tracked him down to a remote fishing spot after the 1984 general election, attempting to evict the Fijian High Commission from his buildings during one of the Pacific nations' coups, and launching baroque legal actions involving traffic offences and former employees. Let's talk broadband. Chorus and Vodafone might have dominated contracts for the government's $1.6 billion or so in broadband infrastructure spending so far, but some councils are lining up bids for new funding with smaller players, Communications Minister Amy Adams has told NBR. Budget 2015 saw confirmation of Ms Adams' election pledge to top up the $1.35 billion ultra-fast broadband fibre rollout with another $150 to $210 million to expand its coverage from 76% to 80% of New Zealand's population. Ms Adams also came through on her promise to top up the $300 million Rural Broadband Initiative, or RBI, with a further $150 million, including $50 million to improve cell phone coverage and mobile black spots, typically in remote rural areas. The new funding is contestable. A registration of interest, or ROI, process is already underway, run by MBIE for both suppliers and stakeholders. A key element is that local councils are being actively encouraged to think about placing joint bids with suppliers as towns fight for a slice of the money, as opposed to the original RBI and UFB tenders, where the big boys like Telecom, as it was then, and Vodafone made bids for the whole of the country covered by the broadband rollouts. Council submissions are shaping up to play a key role in the decision-making process over which towns get UFB fibre as the rollout is extended with the top-up funds. Earlier, a council insider told NBR Radio the whole ROI process seemed set up to subtly steer local bodies toward choosing smaller suppliers. Ms Adams flatly rejects that take. She said, "I think it's very much open. I've deliberately left the process open so it could be providers we've seen before. It could be entirely new providers. I don't have a preference either way." Nevertheless, she adds, "Some councils have indicated to me that they're looking at putting in a joint bid with some smaller local providers in the first instance." Chorus and Vodafone will also aggressively pitch for the funds, and on past form it would be foolish to write off the prospect that they will once again land the lion's share of the funding. But they're going to have to fight for it, town by town. Already the smaller players are sensing blood, especially with Chorus unable to make headway in its fight to gain RMA changes, and concern in some quarters about the pace and structure of the RBI. Councils don't have to nominate a small or large supplier they would like to work with. Ms Adams says the key element in this beauty contest is what the local body can bring to the table. She wants to see what they can bring to the party in terms of resource consents and traffic management, which can make a local fibre rollout faster and cheaper, and what ideas a council has to boost UFB uptake and incorporate faster broadband into its growth plans.
NBR Radio with the Property Press. It's out now to show you around.
In business news, Trans-Tasman food group Goodman Fielder has sliced through its executive ranks after its takeover by Wilmar International and First Pacific. 6 senior managers are to leave the company, including New Zealand Managing Director Peter Reedy. In an email to staff on May 15, Goodman Fielder Chief Executive Scott Wettermeyer said the company was moving to a new organisational structure with a leader for each of its core markets, New Zealand, Australia and international. He said, "I'm pleased to announce that Julie Coates will lead the Australian business and Graham Pickles will lead the international business. We're in the process of appointing a leader for our New Zealand business." Mr Wettermeyer said the changes meant some senior people would be leaving the company. As well as Mr Reedy, the departing staff include Managing Director of Asia Pacific Peter Foyston, Chief Supply Chain and Operations Officer Rob Rogers, Chief Research, Development and Quality Officer Andre Teixeira, Chief Human Resources Officer Fiona McGregor and Chief Procurement Officer Andrew Brightmore. In a statement, a Goodman Fielder spokesman said the new structure would enhance management accountability and improve customer focus in its core markets. He said these executives have each made a significant contribution to Goodman Fielder and they leave with the company's best wishes for the future. Mr Reedy was appointed New Zealand Managing Director in 2010. Former ASX and NZX-listed Goodman Fielder, maker of bread and dairy brands such as Vogel's and Meadowfresh, was acquired by Wilmar and First Pacific in March after a $1.3 billion Australian takeover bid. To the dollar, the New Zealand dollar fell to a 2-month low as upbeat US economic data reinforced expectations the Federal Reserve will hike interest rates this year, boosting demand for the greenback. The Kiwi touched 72.15 US and was trading at 72.18 US at 8 o'clock this morning from 73.13 at 5 yesterday. The TWI dropped to 75.6. The dollar index, which measures the greenback against a basket of currencies, touched a month high following a string of generally positive US data overnight. Reports showed US core capital goods orders rose 1% in April, ahead of the 0.3% expected, as the March figure was revised higher, while measures of consumer confidence, house prices and house sales also improved. ANZ Bank New Zealand senior economist Philip Borkin and senior foreign exchange strategist Sam Tuck said in a note the US dollar found a solid bid as markets found reasons to be optimistic from the latest US data dump. The latest data supports the theory that the US economy will bounce in the second quarter following a weaker first quarter. ANZ expects the Kiwi to trade between 71.6 and 73.4 today. And in New Zealand today, traders will be waiting the outcome of Fonterra Co-op Group's board meeting. The world's largest dairy exporter is expected to provide its first payout forecast for the upcoming season tomorrow morning. Analysts have been pulling back their expectations for the season as prices for dairy products, the country's largest commodity export, haven't rebounded as soon as expected. So the New Zealand dollar was little changed this morning at 93.33 Australian, 66.37 euro and 46.91 British pence. In tourism numbers, MBIE has defended claims the spending figures of Chinese visitors in New Zealand are being inaccurately measured by the government. This comes after the Fresh Information Company Managing Director Shane Valetich told NBR Radio there is a mismeasurement when it comes to the amount of money Chinese tourists are spending in New Zealand. He says the government is saying China is currently a $1 billion market for New Zealand tourism, but the reality is nowhere near this. Mr. Valentich says it's New Zealand's second largest inbound tourism market, and in terms of volume it may be close, but when it comes to value it falls well below some other countries' spend, but is still reported as significant. In the year to December 2014, the total expenditure of Chinese visitors in New Zealand topped the $1 billion mark for the first time, representing 14% of total international visitor spend, according to MBIE. The methodology used to collect this data is an email survey collected quarterly of roughly 10,000 tourists. The survey asks about a visitor's spending in New Zealand and then breaks the numbers down into different components of expenditure. Although Mr. Valentich expresses concerns over the accuracy of these survey figures, Tourism New Zealand Chief Executive Kevin Bowler says there is no better way to get the information. He does admit that the system is not necessarily entirely accurate, as it's just a sample. He said, based on our understanding of best practice around the world, there is no better methodology we've been able to find. He says data is collected from where foreign credit cards are being used, but the issue is there is a proportion of spend which is using cash, which is not as easily collected. Mr. Valentich says on average Chinese tourists are known for their lower than average spending in New Zealand. He said if you talk to enough tourism operators, you'll quickly realise the idea that Chinese visitors spend more than the average visitor is unlikely to be true across the entire Chinese visitor population. In fact, Mr. Valentich says Chinese visitors only accounted for 9% of visitor arrivals in the same period and 7% of hotel room nights. This suggests, he says, that either a Chinese visitor spends much more than an average visitor or the value of the Chinese market is grossly overstated. MBIE Sector Performance Manager Peter Ellis suggests it's the former. He argues that Chinese tourists do spend more per trip than the average visitor. Mr. Ellis admits that there are many people within the tourism industry who don't believe the figures. He says sometimes Chinese visitors may not spend as much on tourism-related activity, but they are big spenders in areas such as retail and duty-free shopping. He says they're only here for a short while, but they spend up big while they are here.
Join NBR's Intelligent Business Network today. www.nbr.co.nz/subscribe. NBR.
In politics, Finance Minister Bill English has hit back at critics of the government's budget measures to lift welfare benefits, who say the changes do not do enough to eradicate poverty. Mr. English's seventh budget, delivered last week, surprised many by including the first real increase in benefit levels since 1972, accompanied by further incentives for people on benefits to get back into the workforce. Asked about measures to tackle poverty and child poverty, Mr. English told a Maxim organised gathering in Auckland last night that those terms have been taken over by ideologues and the government does not trust the way those words are used. He says the term poverty has been captured by a particular idea of how you measure poverty and a particular solution to it. That is, you measure it relative to incomes and the solution is mass redistribution. Those who use the term poverty and child poverty in this way have been admirably open about their objectives, Mr. English told the meeting, but it's not a view the government shares. He said, we're not addressing that phenomenon. What we are addressing is absolute levels of hardship. That is someone not having enough to live, and we don't think that is worse just because someone else has a bit more. Incomes are only one part of what keeps people at the bottom of the social heap, he says, and other factors matter more. He went on, what we're addressing is what I think is the kind of communal or moral dimension, and the worst examples of it are not purely about poverty. They're about ways of behaving, and I don't think poverty is an excuse for serial criminality or beating up your kids. But those are parts of the ways of behaving of parts of our community, in my view sometimes made worse by the way the government deals with some of these problems. These comments came following questions after his speech. In the body of the speech itself, Mr. English outlined some of the ways successive governments have not helped. He said a lot of interventions have failed because we don't understand their culture or their behaviour. We treat them as analytical categories who provide a living by being measured endlessly. He said, for a small country, we must have the most measured 500,000 people, particularly for Maori and Pacific people. They must be the most measured people on earth. Everyone wants to measure and assess. And actually, he says we need a few more people who do things. Get right in there and treat them as people and not categories. To the wool industry, the large-scale expansion of lucrative fine wool sheep breeds onto hill country and flat farmland may hinge on eliminating foot rot through a 5-year selective breeding program. Typically, from high country merino sheep, New Zealand fine wool, that's 24 micron or finer, is in high demand from high-end international clothing companies. However, foot rot costs the sector up to $10 million each year in lost productivity and treatment, while largely preventing merino moving off the high country where drier, colder conditions are less susceptible to the bacteria, to lower, more fertile and accessible farmland where dairying, sheep meat and beef farming have traditionally reigned. John Brackenridge, Chief Executive of Christchurch-based commercial wool marketing and innovation company New Zealand Merino, says we are potentially going to run out of fine wool to sell to leading brands, such as those in the active outdoors market like Icebreaker. So we've worked hard to see how we can extend the breed into other parts of New Zealand. He says from a market perspective, if we can get animals producing the fine wool that markets want on the back of animals that have high meat production and high reproductive capacity, then that's a better route to be going. We could have a product that could really stack up from an economic perspective to provide a great deal of confidence for investment in the New Zealand sheep industry. The response to this challenge is selective breeding. More than 3,500 DNA samples have been genotyped using single nucleotide polymorphism, or SNP chip technology, as part of the Feet First project, the primary growth partnership program between New Zealand Merino and the Ministry for Primary Industries. The program started in 2010 and is due to be completed by the end of this year with encouraging progress. New Zealand Merino has committed $21 million to the program, while the Crown has paid over $13.3 million into it to date. Geneticists based at the Animal Genetics and Breeding Unit of the University of New England have completed initial tests on the 3,500 samples, while the next stage of the program entails building the accuracy of genomic breeding value through progeny testing of an additional 100 fine wool rams over the next 2 breeding seasons.
NBR Radio, Wednesday the 27th. I'm John Stewart. I'm joined by political editor Rob Hosking, who was at a Maxim Institute gathering in Auckland last night, addressed by Finance Minister Bill English, obviously still talking about the budget. He hit back at critics of the government's budget measures to lift welfare benefits, who say the changes don't do enough to eradicate poverty. How did he take the swing at his critics, Rob?
Well, he very much attacked the entire way they tend to define poverty and child poverty. There's that term which has become very much in vogue. And I think effectively said, look, the way it tends to be measured is it's an ever-moving upwards bracket, if you like, because it effectively measures poverty relative to other incomes. And what the finance minister was saying was, look, by that yardstick, you're never going to eradicate it unless you have some sort of old-style massive redistribution of wealth or incomes along, the lines of sort of, old-style socialism.
Yeah.
And basically, look, they're not going to do that. And there was a great line there where he just said, look, we don't mind some people earning more than other people. We just don't want to see people dropping off the bottom, effectively into hardship. And more or less said, look, that's a lot of what this budget was about. And I mean, this afternoon he's talking to business audiences at the Northern Employers, and he's framing that also in business terms, because it's also about making sure that over the longer term, not only are there fewer people on welfare and therefore lower taxes, but also building the skills base so those people are skilled workers and coming back into the workforce.
Indeed, and of course we've got to remember the working poor.
Yes, and that's what Working for Families is very much aimed at, of course. That's one of the legacies of the last Labor government. And that's been changed a little bit this time too. That's been adjusted slightly. And again, there's moves there to encourage people part-time more into the workforce. The government sees a very big part of this as what happens with solo parents and moving solo parents, encouraging them back into the workforce. Those benefit levels have been lifted, but there is also a move to get them out into the workforce a little bit earlier. Now, there's been a lot of argument around that one too, and whether people should be, effectively, induced, if you like, to return to the workforce after 3 years. I think the issue there is that, firstly, most, even well-off parents are back in the workforce after 3 years. But secondly, and this is more important in today's workforce, 3 years out of the workforce is much longer time now than it was even a decade ago, because things are changing so much.
And so rapidly.
And yes, so much and so rapidly. And, you just get out of touch. So that's part of all this mix as well. So this is, although there was a lot of welfare there and a lot of talk about poverty and all the rest of it, this is very important to business audiences.
Of course. So, Rob, what is Bill English saying his critics use as yardsticks for poverty, and what would he and his government use as yardsticks?
Well, one of the things the current government is not very keen on is yardsticks in this area.
No.
And, they're talking about hardship, and they're basically saying, listen, if you're not earning enough to live on, then there's a problem. And so, we had the first real benefit increases above the rate of inflation since 1972, which, that fact still boggles my mind, frankly.
Yeah, that was Norman Kirk, wasn't it? All that far back.
That was the year before Norman Kirk.
Oh, really?
That was the final budget in the outgoing national government of 1972. That was Robert Muldoon, who was the finance minister. It was before he became prime minister, and he deliberately spent a lot so Labor would not have so much to spend when they got in, because it was pretty clear that Labor was going to win that election. And he apparently, it's gone into legend that, after he delivered that budget, he chuckled and said, "I've spent a lot here."
I can hear it now.
Yes, a lot of us can hear that in our nightmares, can't we?
Indeed. Rob, we'd better wrap it up there, but thanks very much for your insights into Bill English's take on poverty. Thanks again.
NBR Radio with Hotel de Brett. Open for breakfast, lunch and dinner and everything in between. NBR Radio.
In market news, Mainfreight, the transport and logistics group, topped its annual profit guidance and said earnings will rise further in the coming year. The Auckland-based company said profit, excluding abnormal items, rose 7.7% to $83.5 million in the year ended March 31st, ahead of its forecast range of $80 to $83 million. The company had a $1.1 million one-time cost in the latest year and a $12.1 million gain the year earlier. Revenue increased 6.8% to $2.05 billion at the top end of its $2 billion to $2.05 billion forecast range. Mainfreight is expanding its operations through Asia, North America and Europe in an attempt to become a significant global logistics business. The company said today its latest earnings had been hurt by a slowdown in Australia and a disappointing performance from its US operations. Still, it said earnings would improve in the coming year, even as current trading in Australia is tougher than expected. Mainfreight said in a statement, "It's our expectation that the benefit of the worldwide network will offset any negativity that we see in Australia as it recovers economically." It didn't provide further details. The company will pay a 20 cents per share final dividend on July 17, taking its annual payment to 34 cents, up from 32 the year earlier. Mainfreight said annual group earnings before interest, tax, depreciation and amortisation rose 8.7% to $162.2 million, ahead of its forecast range of $156 to $160. Excluding the impact of foreign exchange effects, earnings rose 10.4%. In New Zealand, earnings rose 9.2% to $73.6 million, as revenue increased 7.4% to $542.7 million. Mainfreight said the local unit is benefiting from its expanding global network of multinational customers. It's completed new facilities in Christchurch, Hamilton and Auckland, and is eyeing 3 more new builds over the short to medium term. In Australia, earnings rose 5.8% to 37.2 million Australian, as revenue increased 7% to 490.7 million. The company said the last 6 months saw reduced growth over the prior period, and this has continued into the new financial year. We expect a tougher than usual time across our Australian divisions in the short term. In its American business, earnings advanced 1.4% to $19.1 million US, as sales increased 16% to $422.2 million. The company said a poorer second half from Mainfreight USA added to a disappointing performance from Carotrans. In Europe, earnings rose 34% to €11.9 million, as revenue gained 3.6% to €259.7 million. Mainfreight said whilst the European economy remains turbulent, our own improved performance is providing confidence for the future. Trading into the new financial year continues the trend seen in this reporting period. Shares in Mainfreight last traded at $15.90 and the stock is rated an average hold, according to 5 analyst recommendations compiled by Reuters. In politics, Foreign Affairs Minister Murray McCulley committed over $10 million to a New Zealand demonstration farm in Saudi Arabia in order to address a significant impediment in the bilateral relationship between the two countries. Aside from almost $1.5 million to fly 900 U's to Saudi Arabia, a $4 million platform has been allocated to Saudi investors, partly to have access to key customer, business and influencer networks in Saudi Arabia. A further $6 million has been spent on an NZTE-managed package of goods and services from New Zealand, the procurement and selection of which required the input of its Saudi partners. Released under the Official Information Act, the cabinet paper Saudi Arabia Food Security Partnership was written by Mr McCulley in February 2013. In it, he claims that the $4 million platform, the contents of which remain unclear, will be a strong incentive for the Saudi partners to promote the ratification of a FTA between New Zealand and the Gulf states. The paper says the strained relationship between the two countries pose a major threat to New Zealand's trade and economic interests, and that for the previous 3 years the Ministry of Foreign Affairs had been working to resolve the major relationship issue. The issues originated, Mr McCulley says, when Saudi interests, encouraged by New Zealand ministers, began buying New Zealand farms in the mid-1990s in order to build businesses supplying live sheep for slaughter to the Saudi market. Driven by animal welfare concerns, the Clark government moratorium on live sheep exports in 2003, cemented by the customs export prohibition order in 2007, created tensions that became a serious irritant to the Saudi relationship by the time John Key became Prime Minister in late 2008, the paper says. Although he's not mentioned anywhere in the cabinet paper, those Saudi interests appear to be those of Hamoud Al-Ali Khalaf of the Al-Khalaf Group, on whose property the demonstration farm is being built in Saudi Arabia. New Zealand taxpayers are effectively gifting Mr Khalaf $10 million for the demonstration farm, as the Al-Khalaf Group will retain full management and ownership of it, including the ewes and their progeny. It's understood Mr Khalaf's grievances over his inability to export his sheep from New Zealand to Saudi Arabia for live slaughter helped create the major relationship issue between the two countries that has contributed to the stalling of the FTA. To an advertising stoush. A war of words has erupted between Harcourts and Saatchi & Saatchi, following a competitive tender for the real estate firm's advertising account. Yesterday, indie agency Contagion announced that it won the Harcourts creative, media, digital strategy and social media account against Ogilvy and Mather and Saatchi & Saatchi. The press release rubbed Saatchi up the wrong way because it said the Auckland-based Saatchi took part in the pitch. This prompted Saatchi to send out an email to the industry which said, "While we did have an initial conversation with Harcourts about the opportunity, we didn't participate in the pitch process. So to say that Contagion won this against us wouldn't be correct." Speaking to NBR Radio, Harcourts Chief Executive Hayden Duncan said Saatchi did take part in the pitch, but its work was unsatisfactory. He said maybe it just wasn't their day. "I have nothing against Saatchi, but what Contagion presented was light years ahead." Saatchi General Manager Paul Wilson said Mr Duncan's response was odd. He says the agency did an initial meet and greet, but did not answer a brief or develop and work for them. Executive Creative Director Corey Chalmers and I popped in to meet them and share some case studies and listen to their brief. We let them know how we'd approach the brief, but didn't develop a strategic or creative response. NBR attempted to clear up the differing opinions and asked Harcourts Mr Duncan for the pitch documents, but he declined, saying, "I'd rather not get involved with Saatchi's politics." One industry observer said perhaps Saatchi's definition of a pitch differed to that of Contagion.
You're listening to NBR Radio. Upgrade to My NBR Radio with a smartphone-only subscription to NBR Online today for free and receive unlimited access to NBR Online on your smartphone until August 31st. Visit www.nbr.co.nz/free.
To our economy. The New Zealand economy is expected to grow at about 3% a year through to 2017, driving jobs growth and reducing the unemployment rate, according to the New Zealand Institute of Economic Research's quarterly predictions. The Institute estimates 130,000 jobs will be created over the next 2 years, with the unemployment rate dropping to 5.2% by early 2017 from 5.8% currently. It said wage growth will be somewhat muted at about 2.5%, reflecting broadly weak inflation and the impact of strong net inbound migration, which is expanding the workforce. With little inflation, the Institute expects inflation to stay below the midpoint of the Reserve Bank's 1 to 3% target band well into 2017. But even combined with an uncertain global outlook, the bank probably won't see scope to raise interest rates until mid-2017 because of concern it could inflame Auckland's housing market. The Institute says the economy does face challenges. The decline in dairy prices would strip $6 billion from rural incomes, while the Auckland housing market is vulnerable to a sharp correction. It expects restrictions on the Auckland market from the central bank, and government will only dampen housing demand at the margin. It also said the Canterbury rebuild is close to its peak and its impetus will start to fade. In employment news, Scott Technology has confirmed it laid off 13 workers as the industrial automation firm looks to cut staff numbers at its Christchurch plant after taking on extra employees during a bumpy year, Chief Executive Chris Hopkins says. The Dunedin-based firm last week told workers their positions were redundant at the Christchurch plant, according to a statement from the Engineering, Printing and Manufacturing Union. Mr Hopkins confirmed the statement, saying the appliance-focused plant's staffing gradually increased through a busy 2014 and had now been reduced to about 70 workers. He said about 60% of staff at the plant are represented by the EPMU. Mr Hopkins told Business Desk it's a bit more dramatic than the reality, that's for sure. It's just in response to the decline in our forecast production in our Christchurch plant. We manufacture in 4 countries around the world, and we've got 6 manufacturing sites in New Zealand. We had a busy 2014, and we took on permanent staff to meet that increase in demand, and this is just returning staff levels to similar levels that we were in 2012 and 13. Last October, Scott Technology said its manufacturing businesses were coming under pressure from the strong New Zealand dollar, which eroded export earnings. Mr Hopkins said the redundancies were related to less demand at the Christchurch plant, not shrinking margins. Mr Hopkins said we've allocated and reallocated some work up to Christchurch to make up for the forecast downturn in appliance manufacturing which the Christchurch plant makes. We've been discussing this with the union for months, so it's certainly not a shock to it. Ross Heslop, EPMU organiser for the Scott Technology staff, said they sought to hold off the redundancy until the manufacturer knew whether it would be successful in winning several contracts up for tender, but were rebuffed. Mr Heslop said they've indicated they want to move away from the employee model and begin relying more on temp workers to fill orders. Last October, Parliament passed legislation in an effort to increase labour market flexibility and cut the regulatory burden and compliance costs for small and medium-sized businesses. Chief among the changes are new working arrangements where employees can request work hours that suit them, the ability to negotiate rest breaks to meet workflows, provisions to protect vulnerable workers, a faster turnaround for Employment Relations Authority decisions, and a series of changes to collective bargaining to reduce ineffective negotiations. Scott Technology acquired 3 businesses over an 18-month period and has flagged it will need to raise new capital to reduce borrowings. Those acquisitions helped drive a 40% gain in first-half profit to $1.1 million on a 16% lift in sales to $29.3 million.
NBR Radio, Wednesday the 27th. I'm John Stewart. The pay TV operator Sky Network Television staged an investor day yesterday. Our reporter Jenny Ruth has been covering that story and she joins me now. Jenny, what did the company have to say at this meeting?
Well, the company wants us to believe that the advent of video streaming over the internet presents Sky with more opportunities than it does threats. Sky, of course, has launched its own streaming services, Neon and FanPass, but the big concern among investors has been how much this will cannibalise Sky's existing platform and how much of a threat other services such as Lightbox, Netflix and QuickFlix will be. But Sky's Chief Executive John Follett says the market for these streaming services seems to be quite different from the market for the customers that it currently has on the Sky platform. Time, of course, will tell on that.
So you remain a little sceptical as to whether they are threatened.
Well, I don't think it's any surprise that Sky's share price has not performed over the last year since more and more of these services came online.
But the company is having to spend more on programming.
Well,
why is
that's part of fighting the competition. Traditionally, it's spent between 30 and 33.5% of revenue on program costs, and it's flagging that that's going to rise to 35% in the year ending June next year. As well as having to pay more for individual program rights, Sky's also having to offer more content as part of combating all this new competition. And it's lost some sports content. It lost the US PGA golf rights last year and the English Premier League in 2013. Mr. Follett says that he really doesn't want to lose any more of this valuable type of content.
I bet he doesn't.
Well, that's also one of the reasons why Sky's raised its prices for basic and sports offerings. He says that it's too early to judge whether Sky's going to lose customers as a result of that.
Now, Sky's also warned that it won't be increasing its dividend payout. Why is that?
No, it won't be. Mr. Follett says the payout's going to stay at 70% of net profit, which is where it currently is, because the company's having to invest a considerable amount to keep up with this competition. Examples of that is $30 million a year through to 2023 for its Optus satellite commitments, and capitalised costs of about $50 million a year in 2015. That's to cover the cost of installing and maintaining set-top boxes. And its TV station assets are also 9 years old and will require replacing at a possible cost of about $40 million. Sky is currently producing annual positive cash flow of about $300 million, so it's not short of funds, but Mr. Follett is signalling that the company's got plenty to spend that on.
Thanks very much, Jenny.
NBR Radio with Baileys, New Zealand's leading commercial real estate company.